In this video, we are going to bridge the gap between having a good idea and having a professional trading system. By the end of this session, you will be able to construct a mechanical trading plan that removes emotion and guesswork from your execution. Many traders find a setup, like a head and shoulders pattern or a moving average cross, and think they have a strategy. They don't. A setup is just a pattern. A strategy is a complete business plan for a trade. To be considered a strategy, your plan must have 5 non-negotiable components. First, the entry trigger. This is the exact mechanical moment you click buy or sell. Second, the stop-loss rule. This is your uncle point where the trade is proven wrong. Third, the target or exit rule. How and when do you realize profits? Fourth, the position sizing rule. Exactly how many shares or contracts do you buy based on your account balance? And fifth, the market condition filter. This defines when you should stay on the sidelines. For example, I only trade this trend following system if the price is above the 200-day moving average. If you are missing even one of these, you aren't trading a strategy. You are gambling on a hunch. Before you can build your rules, you must pick a lane. You cannot be all things to all market conditions. Our learning objective today is to distinguish between trend following, mean reversion, and breakout philosophies. Trading strategies generally fall into one of 3 philosophies. The first is trend following. The philosophy here is that an object in motion tends to stay in motion. You thrive in trending markets but suffer death by 1,000 cuts during sideways, choppy ranges. The second is mean reversion. This assumes that prices eventually return to an average. You sell high at resistance and buy low at support. This thrives in range-bound markets but gets crushed when a real trend starts. The third is breakout trading. You are looking for a volatility expansion. You buy when the price clears a level that previously held it back. This offers high rewards but often comes with a lower win rate. Let's do a quick self-assessment quiz to see which style fits you. 1. Do you prefer high win rates with small gains? If so, mean reversion might be for you. 2. Do you have the patience to sit through many small losses for one massive winner? That's the hallmark of trend following. 3. Do you like fast-paced action and volatility? You might be a breakout trader. Take a moment to think about your temperament. If you try to trade a mean reversion strategy in a trending market, or vice versa, you will fail. Pick one lane and master the market conditions where it thrives. Now that you have picked a lane, we need to design your entry rules. The goal here is to move from discretionary to mechanical. An entry rule must be so clear that if you gave it to 10 different people, they would all take the exact same trade at the exact same time. Phrases like "the candle looks strong" or "overbought" are useless because they are subjective. Let's build a sample entry rule using confluence. First, we establish the trend. If the price is below the 50 EMA, we don't buy. This is our filter. Second, we wait for value. We don't chase the high. We wait for a pullback to a logical floor. Third, we need the trigger. The engulfing candle is our mechanical green light. A common mistake is adding too many filters, like requiring 5 different indicators to line up perfectly. This is called curve fitting. You are making the strategy fit the past perfectly, but it will likely fail in the future because it is too rigid. Aim for 2 or 3 strong confluence factors. Once you're in a trade, your most important job is managing the exit. Let's start with where you place your stop loss. Many beginners use a fixed percentage stop, like 2% below my entry. The problem is that the market doesn't care about your entry price. It cares about structure. A structure-based stop is placed behind a level where, if the price hits it, the reason for your trade is officially invalidated. For a long trade, this is usually just below the most recent swing low. This allows the market room to breathe within its natural volatility. Now, how do you exit for a profit? You have 2 main philosophies: single target and trailing stop. With a single target, you have a higher realized win rate, but you might miss out on a massive runner. With a trailing stop, you use a method like the average true range, or ATR, to move your stop up as the price moves in your favor. This catches big trends, but often results in getting stopped out during minor pullbacks. If you trade options, be careful. A 50% loss on the premium might trigger even if the underlying stock hasn't hit your technical level yet, due to time decay or volatility crush. Generally, it is superior to exit based on the price action of the underlying stock, not the option price itself. Most traders fail not because of bad entries, but because of bad math. Position sizing is the engine of your strategy. Without it, even a 70% win rate can lead to bankruptcy. The golden rule: never risk more than 1 to 2% of your total account on a single trade. Let's look at the actual formula you should use before every single trade. Suppose you have a $10,000 account and you decide to risk 1%. That means your account risk amount is $100. If your entry is at 150 and your stop loss is at 145, your risk per share is $5. 100 divided by 5 equals 20 shares. You should buy exactly 20 shares. If you lose exactly $100, or 1%. Think about this. If you have a 50% win rate, but your winners are twice as big as your losses, you are mathematically guaranteed to make money over time. Proper position sizing ensures that no single bad beat can take you out of the game. Some traders like to scale in, adding to a position as it goes in their favor. This lowers your initial risk but increases complexity. For now, focus on mastering a fixed size until your execution is flawless. Now that your rules are set, you must prove they work. You don't do this with real money. You do it with a backtest. Using a tool like TradingView's bar replay, you should go back in time and move the chart forward one candle at a time. Every time your entry rules are met, you record the trade in a spreadsheet as if you were trading it live. A common mistake is testing 10 trades, seeing 8 winners, and thinking you are a genius. This is small sample bias. You need at least 100 trades to see how your strategy handles different market moods or regimes. You need to track specific metrics. First, win rate. Second, average R multiple. Third, expectancy. And fourth, max drawdown. Expectancy is your most important number. It tells you how much you can expect to make for every dollar you risk. If your expectancy is positive, you have an edge. Be aware of common biases. Look-ahead bias involves using information from the future to enter a trade. And slippage, which is forgetting that in real life you might not get filled at the exact price you want. In a backtest, everything is perfect. In reality, fees, commissions, and slippage will eat into your profits. If your backtest shows a tiny profit, the strategy will likely lose money in the real world. Once your backtest shows a positive expectancy, you might feel ready to jump in with your life savings. Stop. They don't account for your emotions, your internet connection, or your ability to actually follow the rules when real money is on the line. Forward testing, or paper trading, is where you trade in real time using a demo account. This is crucial because it introduces the element of time. In a backtest, you can click through a month of data in 5 minutes. In forward testing, you have to wait hours or days for your setup to form. This tests your patience, not just your logic. When paper trading, be honest. If you are trading a stock with low volume, assume slippage, meaning you get a slightly worse price than the screen shows. Record these discrepancies in your journal. The goal isn't to make fake money. The goal is to build the habit of execution. Refer back to our Module 6 journal template. During this phase, you are tracking execution errors. Did you take a trade that didn't fit your rules? Did you exit early out of fear? If you cannot follow your strategy in a demo account, you certainly won't follow it when your hard-earned capital is at risk. Stay in this phase until you can execute 20 trades in a row with 0 emotional errors. One of the hardest skills in trading isn't starting a strategy. It's knowing when to kill it. Every strategy has losing streaks. This is called a drawdown. If your backtest showed a maximum of 5 losses in a row and you are currently on your 4th loss, that is normal. It's part of the business. However, a strategy is broken if its performance falls outside of its historical statistical norms. You should set objective kill criteria before you start trading. Some examples include 1. Max drawdown exceeded by 20%. 2. 10 consecutive losses if your backtest max was 6. Or 3. A change in market regime like a volatility-based system in a dead market. Let's distinguish between a losing streak and a structural failure. A structural failure happens when the market environment changes so fundamentally that your edge no longer exists. For example, a strategy that exploited a specific technical glitch in an exchange is broken once that glitch is patched. If you hit your kill criteria, stop trading immediately. Do not hope it turns around. Go back to the research phase. It is better to preserve your remaining capital for a new strategy than to go down with a sinking ship. To summarize this module, you defined your 5 non-negotiables. You chose a philosophy, you built mechanical rules, you mastered position sizing, and you validated everything. You now have a complete professional strategy. In the next module, we will discuss how to scale this system as your account grows.